The IRS just released new updates on the upcoming changes for retirement accounts like the IRA, 401k, 403b, and a few others that I'll mention throughout the video. But before we get started, my name is Danny Sully, and all I ask is if you do find value in this video, that you consider hitting the like and subscribe button for future content like this. With that said, let's first go over the new changes to the IRA. Now, the IRA is commonly known as an individual retirement account, where this account gives you more control over the investments you choose and how you manage the account. Now, because of my age and situation, I personally favor the Roth IRA over the traditional, but as a whole, the amount you are able to contribute into the account every year is called the contribution limit. And for this, understand that the amounts are combined among any traditional or Roth IRA accounts that you have. And so these numbers have just increased for the year of 2026, where it is now up to $7,500, which is up $500 from 2025's limit. On top of that, the additional catch-up contribution for those that are 50 and above is now bumped up to $1,100 compared to $1,000 that it was in 2025. But something to realize here is that the Roth IRA in legal writing limits if you can contribute into the account based on your income, where they have just increased the income threshold. So for 2026, if you're single and your modified adjusted gross income is below $153,000, then you are eligible to contribute the full contribution amount into an IRA. If your modified adjusted gross income is between $153,000 and $168,000, then you can only contribute a partial amount into the IRA. And then if you are above $168,000, then you are not eligible. Now, if you are one in the gray area on this, also know there's something called a backdoor Roth IRA, which pretty much allows high income earners to still find a way to contribute into their Roth every year. To sum it up, you pretty much are contributing to a traditional IRA and then converting that to a Roth, but definitely do your own research on this. And if you are going forward on it, I'd highly recommend talking to a professional to ensure you do things properly. But aside from that, realize that if you are married filing jointly, the number to stay under here is $242,000. Because if you're between that and $252,000, then you can only do a partial amount. And then if you're over $252,000, you are not eligible. So knowing the changes the IRS made to the IRAs, let's now go over employer-sponsored plans like the 401k. So the first area to cover here is the contribution limits for 401k plans. And if you're not familiar, a 401k is pretty much a retirement plan that an employer offers to employees, allowing you to invest for your future. And so for 2026, the contribution limits increased to $24,500. That is up $1,000 from 2025's limits, that is per employee, where you can now do up to a total of $72,000 when you include the employer's contributions, which is up $2,000 from 2025. Now, they also have a catch-up contribution for those that are age 50 to 59 or 64 and above, and that is $8,000, which is up $500 from 2025. And then for those that are age 60 to 63, the additional catch-up contribution is even higher at $11,250. That has remained unchanged. Now, if you are one using a 403b, you can see that the contribution limits are all the exact same, and the same concept applies for those using governmental 457 plans and the federal government's thrift savings plan. And the last account I want to touch on here, even though it's not a retirement account, is a health savings account known as an HSA. Now, I'm currently using an HSA to invest for any of my future medical expenses, but do know that you can use the funds in the account at any instant, so this account is not strictly for retirement. But the biggest benefit of this account and why I highly recommend it is because if you are eligible to use an HSA, it is a triple tax advantaged account, which means whatever you contribute into the account is tax deductible. For many of the accounts, you can invest in them and that growth can be completely tax free. And if used for qualified medical expenses, any of the withdrawals are also tax free. And another fact about HSAs that many don't realize is that if you are above 65, you can use any of the funds for any purchases, no penalties, but you will have to pay ordinary income tax on the withdrawals if it's not for a medical purpose. But as far as changes for the HSA, the IRS has also released new limits that have increased for the year of 2026, where if you are one on your own, the new limit is $4,400 per year, up $100 from 2025's limits. And then if you are under a family plan, the new 2026 limit is $8,750. that is up $200 from 2025's limit, and do know that catch-up contributions did not change. On top of that, the IRS also adjusted the minimum deduction and max out-of-pockets for high-deductible health plans for 2026, where the minimum deductible is $1,700 for individuals and $3,400 for families, where the max out-of-pocket is $8,500 for individuals and $17,000 for families. Now, if you want to see our previous video on the 2026 federal tax brackets and standard deductions, I'll have a direct link below for you to check that out. And while you're at it, if you want to check out some of the top brokerage accounts or even high yield savings accounts that are currently available on the market, I'll also have direct links to those in the description below. End of the day, our mission at InvestLane is to help you save and invest wisely to build lasting wealth. So please do whatever you believe is best for your situation. This is not financial advice, and you must do your own research. And as always, don't forget to hit the like, subscribe, and notifications button for future content like this.